Hello, good evening, and welcome to this evening's class. Please, as I have always done, if you can hear me, raise your hand up. If you can hear me, please raise your hand up. Raise your hand up, please, if you can hear me. I can only see 11 hands up. I have 16, 18, 20. Okay, so I have more than half of the current number of participants raising their hands up. Okay, so that's good. So today we are going to complete our discussions on cost. And if I have quite a number of you, probably if it's above 60, then I would start with market structures. But if I don't have more than 60 students, I don't think it would be fair to start with market structures. So if I have more than 60, or let's say 55 thereabout, that is about 1/3 of the class, then I would start with market structures. But if I don't, then we would start market structures next week, all things being equal. So far, we have been looking at production and cost. We started with production, and then we look at production in the short run and also in the long run. Although the long run, we didn't go too much into details. And then we looked at cost. So cost too, we are looking at short run and long run cost. But at the moment, we've been looking at short run. So we said that in a short run, cost can be categorized into two: fixed cost and then variable cost. Fixed cost because there's a fixed input, right? So the fixed cost is the cost for, or the cost that a firm incurs on a fixed input. And then the variable cost is the cost that a firm incurs on the variable input. And we know what a fixed input is, and we also know what a variable input is. So there are different types of, or different categories of cost in the short run. So there are the totals. So we have the total cost. We also have total fixed cost, total variable cost. So the total cost, or let me say the total fixed cost, is the total cost incurred on the fixed input, whilst the total variable cost is the total cost incurred on the variable input. So if you sum the two, that gives you the total cost for the firm. Then we also have the marginals and the average cost. So we have the marginal cost, which is the change in total cost as a result of a unit change in output for the firm. So that gives us a marginal cost. Now, in addition to marginal cost, we have the average variable cost, we have the average fixed cost, there is also the average total cost. So we looked at all these categories of cost and also show mathematically how these can be derived. Then we also looked at the cost function. So it says it's basically a mathematical expression of the relationship between total cost of the firm and then the output of the firm, right? So today we are going to look at the relationship between production and then cost, right? So they go together. I mean, once production activity is taking place, cost is incurred. And there's a relationship between some of the measures of productivity in case of production and also some of the categories of cost. So we are going to look at that today. Now, when we are done with that, we will look at what are the factors that will shift the cost curves. What factors will shift the cost curves, whether downward or upward. and then when we finish, we'll look at some long run cost if there is time. And then once we are done, depending on the number, at the moment I have about 73 participants, so if I take myself out, we have 72. So we would be able to continue the lecture by looking at market structures. Okay. So first of all, I would want to start with the relationship between one productivity measure, which is the marginal product of labor, and also one category of cost, which is the marginal cost. Now, there are some equations you see on your screen, right? There's one to the left, and there's also one to the right. The one to the left shows the relationship between the marginal cost and also the marginal product of labor. Now, before I go into the derivation of this relationship, the relationship is an inverse one. So there is an inverse relationship between the marginal cost of the firm and the marginal productivity of labor for the firm as well. So an inverse means that when marginal cost, or let me start from when marginal product of labor is increasing, the marginal cost is decreasing, and vice versa. In other words, when the marginal productivity of labor is decreasing, the marginal cost of production would be increasing. And we can also show that when the marginal product has reached a maximum, marginal cost also reaches a minimum, right? So that is the relationship, and that is proven with the equations you see on your screen. So let's focus on the one on the left. So it's first of all start with the total cost being equal to the price of labor. So that should be the total variable cost, right? So not just the total cost, but in the short run, because the variable input is labor, so the total variable cost for the firm is equal to the price of labor times the quantity of labor that the firm employs. So please, what is up here should be the total variable cost, or you can say that change in total cost would be equal to the price of the variable input times the change in the variable input. Note that we are in a short run. So what changes our cost is a change in the variable input. The fixed input remains the same, it does not change. So we can say that change in total cost in the short run is equal to the price of the variable input times the change in the variable input, right? So we also know that the change in marginal cost, marginal cost is a change in total cost over the change in quantity. Now let me switch to the whiteboard to explain this further, because some of the equations here. So let me just switch to the whiteboard to explain this further. Okay. So I am switching to the whiteboard. So this is what I'm saying, that you can see that your change in your total cost, right, will be equal to the price of the variable input times the change in the variable input, which is also equal to your change in your total variable cost, because what changes in the short run is the variable input. And you know that our variable cost, or the total variable cost, is the price of the variable input times the units of the variable input employed, right? So in the short run, change in total cost is equal to change in variable cost. So this is what I'm saying, that in the short run, change in TC will be equal to change in TVC, right? And we are saying that our marginal cost is equal to your change in your total variable cost divided by your change or the change in output. That gives you the marginal cost, which would mean that marginal cost again is equal to the change in total variable cost over change in quantity. Note that this is only in the short run. This is only in the short run. This is only a short run phenomenon. So it means that marginal cost will be equal to the price of the variable input times change in L over all over change in Q, right? So we can simplify this to be price of L over change in Q over change in L. Now we know from our discussions of production that change in quantity over change in L is a marginal product of labor. So therefore, marginal cost will be equal to the price of the variable input over the marginal product of labor. So I can write that here. MC is equal to the price of the variable input divided by the marginal product of labor. So this gives us the inverse relationship, which says that when marginal product of labor is increasing, so when this one is increasing, and the MC will be falling. And when the marginal product of labor is decreasing, the MC will be rising. So that gives us that inverse relationship. All right. So that is this one. Then the other relationship is between the average product of labor and the average variable cost. So let me go back to the slides. Okay, so the second relationship is what you see on your right. So we have the average variable cost to be equal to the total variable cost divided by the quantity. And we know that the average variable cost is the price of the variable input multiplied by the units of the variable input, or the total variable cost is price of the variable input multiplied by the units of the variable input employed by the firm. So if you divide that by Q, again, we can have, let me switch back to the whiteboard to explain this also further. So what we are saying is that the average variable cost of the firm is equal to the total variable cost divided by quantity. And we know that total variable cost will be equal to the price of the variable input multiplied by the units of the variable input employed, which is labor, and then you divide that by Q. Again, we can simplify this or rewrite this equation to be PL over Q over L mathematically, which will be equal to, now we know that Q over L is the average product of labor. So which will be equal to the price of the variable input divided by the average product of labor. So again, the average variable cost can be expressed in productive terms as the price of the variable input divided by the average product of labor. So you see an inverse relationship here as well. When the average product of labor is increasing, you see that the average variable cost reduces. And then when the average product of labor decreases, then you see your average variable cost going up. So that is the other relationship. So we can show these relationships on the graph. We can show these relationships on the graph. And that's what you have here. So we can show these relationships on the graph. So let me, okay. So all this is just explaining the same things that I've just told. So this is what I'm talking about. So we are saying that the firm's marginal cost curve is linked to its marginal product curve, as I have shown using the equation earlier on, or the derivation. So you clearly see that when marginal product rises, marginal cost falls. So the marginal product is a U-shaped, right? So sorry, the marginal product is an inverted U, and then the marginal cost is a U-shape, right? So at lower levels of output, you see marginal productivity increasing, but marginal cost decreases, right? So now another relationship is that if the marginal product of labor is at the maximum, the marginal cost is also at the minimum. That's another thing that I want you to take note of. And then we also have the relationship between the average variable cost and then the average product of labor. So you see that if the average product rises, the average variable cost falls. And if the average product is at the maximum, the average variable cost is at the minimum. Right. So you can look at that as well. So those are the differences or the relationship between the product curves and also the cost curves. Okay. So, sorry. All these are trying to explain that relationship. So if you have the slides, you can look at. Now, once that is done, let's look at what will cause the cost curves to shift. Right. So if you look at the cost curves that we had, we drew the cost curves for particularly the averages. We have the marginal cost, which is a U-shaped, the average total cost, average variable cost, they are all U-shaped, but the average fixed cost continue to fall, but it never cuts, or it will never cut the x-axis. And I remember saying that lines that have these kind of characteristics are referred to as asymptotic. Right? So they never cut the x-axis. So what are some of the things that will shift the cost curves? So there are two things that comes to mind. One is all those factors that will shift the product curves will also shift the cost, some of the cost curves, not all of them anyway. So if the total product curve, for instance, is affected, then it has implications on total cost, marginal cost, and then so forth. Again, if the average product curve is affected, it has implications on the cost curves. And then if the marginal product curve is also affected, it has implications on the cost curves as well. And then the other one is input prices. So when input prices are also changed, or it have implications on when input prices are changed, it has implications on the cost curves as well, right? So the question is, what can cause the product curves to shift? And one main thing that causes that is technology. So when there is improvement in technology, means that you can produce more using the same units of labor, then it has implications on our cost curves, right? So let's look at that. What So technology, for instance, so when technology changes in favor of a particular production process, then you're likely to see that the total product curve would shift upward. The average product curve will also shift, and the marginal product curve will also shift. Now, when these are affected, then it has implications on our marginal cost, has implications on our average variable cost, as we have shown that there is a relationship between the marginal cost of the firm and the marginal product of labor, and also the average product cost of the average product, and then also the average variable cost of the firm. So technology has implications on. So for instance, when there's an improved technology, output can be produced using the same units. So this lowers the average and then the marginal cost of the firm. Then the second one is the input prices. So input prices. Now a change in input price affects the cost curves. Now which of them is affected depends on which input price has changed. Right, so let's look at them. So when price of input increase, they become expensive and shift some of the cost curves. Not all of them, so it depends on which one has experienced a change in its price. Okay, so let's look at the fixed input. Assuming that it is the price of the fixed input that has changed, then let's see the categories of cost that will be affected. Obviously, it's going to affect the total cost of the firm. You clearly see that the total cost of a firm would be affected because the total cost is made up of the total fixed cost and also the total variable cost. So if the fixed cost is increasing as a result of an increase in the fixed input prices, then we are likely to see our total cost shifting upward. Now, in addition to the total cost curve, the average fixed cost will also be affected. Of course, the total fixed cost will be affected, and therefore the average fixed cost will also be affected. Right. So apart from, and if average fixed cost is affected, then our average total cost will also be affected. Right. So this is what we have here. So when there's an increase in the price of the fixed input, both total fixed cost and average fixed cost will shift, will shift upward. Total, TC will also shift upward. And then, of course, the average total cost is also going to shift. That is not included here. So your average total cost will also shift because the average fixed cost has shifted. All right, so the ones that will not be shifted are our average variable cost, average or the marginal cost, and then also the total variable cost will not be affected. Then what about if it is a variable input? It is the price of the variable input that has increased. Then you can clearly tell which of the components or the categories of cost that will be affected. So you first of all know that your total variable cost will be affected, and therefore your total cost will also be affected. Your average variable cost will also be affected. Your marginal cost will also be affected. And then your average total cost will also be affected. What will not be affected would be your total fixed cost, and then your average fixed cost will not be affected. So this will shift the TVC and then AVC upward. Your marginal cost will shift upward. Your total cost will also shift upward. Your average total cost will also shift upward as well. But what will not change is your average fixed cost and then the total fixed cost. Okay. Somebody is asking why it is asymptotic, and I'm saying that it is asymptotic because it can never be zero, right? Your average fixed cost can never be zero, right? Although it will get very close to zero, but it can never be zero. You always get 0 point something 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 0 0 0 or 1. So it will never cut the x-axis. So that is why it is asymptotic. It can never be zero. It will continue to be parallel to so I don't know why, Kingsley, you are still asking why. I mean, it's quite obvious. Is mathematically you are dividing the average fixed cost is the total fixed cost by output. So as long as there is a fixed cost and you continue to increase output, you can never have it to be zero. I don't know why you don't. So what I'm saying is that I'm dividing AFC, which is equal to TFC over Q. I'm saying that this value here can never give you zero. It can never be equal to zero. You always get a decimal. So I can even get it as 0.00001 something. But I can never divide it and get zero. That's why that's why it said that it is asymptotic. Right? You can't get zero here because you have a total fixed cost, which is a positive value. This is also positive value. No matter how big the quantity is, you would always get a decimal that is not exactly equal to zero. So that is why we are saying that it is asymptotic. I hope it's clear to you, Kingsley. Okay, so did I see a hand up? Okay, so I've seen beloved Mary Okuri. Okay, so the person has okay, so the person has dropped their hand, lowered the hand. Okay. So those are the, so like I'm saying, if you there's a change in the price of a variable input, the obvious ones are the total variable cost will change, your average variable cost will change, your total cost will also change, your marginal cost will also change, your average total cost will also change. But what would not change is your average fixed cost, and then your total fixed cost will not be affected. Okay, good. So that is it for the issue about costs. Any question on that before? I think I have the numbers to do market structures. Yes. So any question on this before I move on to the market structures? Any question on this before I move on to market structures? Okay, so there are no questions. So I assume that you've all understood this concept of production and cost very well. Like I said, at this point, you can begin to start looking at the past questions we have because you have enough to be able to solve almost 70 to 80% of the past questions. So you should start looking at that from now. Okay, so now let's move on to market structures then. So when we say a market structure, we are basically referring to the environment in which the firm finds itself. And the environment has significant implications on what a firm can do. So some firms find themselves in an environment where they do not have control over the price of the items that they sell. Some firms also find themselves in a place where they are the sole firms in the industry, and therefore they can either increase price or decrease price at any time that they want. Some firms find themselves in a competitive environment where what they do spark reactions from other firms and all that. So market structure basically refers to the environment in which the firms find itself, and that has implications on what the firm can do. So there are four main types of market structures that we'll be looking at. We have the perfectly competitive market structure. We have the monopolistic competitive market structure. We have the monopoly market structure. And the last one is the oligopoly market structure. Those ones that will be studied in detail for the purposes of this course is the first three, which is the perfect competition, the monopolistic competition, and then the monopoly. The oligopoly will be left out for those who will probably be doing managerial economics when they get to level 300 and all that. Although I will briefly describe what the market structure is, but it will not be treated in details. So by today, I am going to start with perfect competition. And by the time this topic is concluded, these are the things that I expect you to be able to do. One is for you to be able to identify the different market structures based on some characteristics, understand what a perfectly competitive industry is, be able to select the price and output that will maximize profit in the short run for a perfectly competitive firm, and also be able to select a price and output that will maximize profit for a perfectly competitive firm in the long run. So today's discussions would be on perfect competition, which is one of the market structures, right? So like I said, there are four types of market structures. So there's perfect competition, there is monopoly, there is monopolistic competition, and then there is oligopoly, right? Now, there are some characteristics of the market that are used to identify whether this market is a perfectly competitive firm, this market is a monopoly, this market is a monopolistic competitive firm, or an oligopoly market. So those are the things that I want us to quickly look at. What are the defining characteristics? So you see a table on your screen, and this are the defining characteristics. First, you want to look at the number of firms in the industry. You also want to look at the nature of the product in the industry. You want to look at the entry procedure. Is entry costly, or there are no cost to entry or barriers to entry? You also want to look at the information availability. Is information perfect or imperfect? And then, of course, we tend to add the firm's control over the price of the items that it sells. So let's focus on perfect competitive market. Now, it's a market that is characterized by a very large number of buyers and sellers. Very large number of buyers and sellers selling homogeneous product. So homogeneous here means that the product sold in the industry or market is the same in the eyes of the consumer. The consumer does not see difference in the product sold in the market. There is no barrier to entry. In other words, there is free entry and exit in this market. So if someone wants to enter the market and trade in the products that is being sold in the market, nothing stops you from doing that. There are no restrictions for you when you want to enter the market. And there are also no barriers for you when you want to leave the market. You can leave the market at any time and also enter the market at any time. Information in this market is complete. In other words, there is perfect information. So there are no information asymmetries. The buyers and sellers in the market are aware of all information in the market. And then, of course, the last one, which is a characteristic of a firm in this industry, is that the firm in a perfect competitive market is a price taker. The firm has no control over the price of the item. The firm enters the market and starts selling the commodity at the price that has been dictated by the market. So in other words, the individual firms cannot influence the market price, but collectively they can do that. So please take note of this. Individually, they are price takers. They cannot influence the price in the market, but collectively they can do it, right? So in reality, it is very hard to find a market that satisfies all these conditions. So therefore, in some of the textbooks, they distinguish between pure perfect competition and the impure perfect competition. So we have market or industries that are very close to this perfect competitive market, but do not satisfy all the characteristics, particularly the characteristics on information availability, which is information being perfect. In most cases, we do not have a perfect information. We do have an imperfect one. So a market, an example of an industry or market that comes very close to this is, I would say, the market for mobile money, right? The market for mobile money, where you do mobile money transfers, you know. So what do we see? We see that there are very large number of people involved in this industry, and there are very large number of buyers as well, those who seek the services of mobile money, a lot of them, right? Now, the services provided by these mobile money vendors is the same in the eyes of the consumer. So if I have two mobile money vendors sitting at two places, one at the first one and one at the second one, unless I have my own maybe other preference, but if I want to use the quality of the product, they are the same to me or to the consumer. So the consumer does not distinguishes or cannot distinguish between the product of this firm from that of that firm. So they are the same, they are homogeneous products. There are no restrictions when it comes to entry and exits. I mean, you can, in fact, you can even go. I'm sure some of you are even into the mobile money business where you have your phone and your friends can come to your rooms where you do mobile money for them and all that, right? So there are no restrictions when it comes to going into that business, right? The problem is information asymmetry. The information, whether information is perfect, that is a little bit debatable. But the price that these mobile money vendors sell or transfer money is the same, you know, and they do not have control over it. The price has been set. So for every 100 Ghana cedi that you transfer is 1 cedi. Every 200, anything above 1,000 Ghana extensively. So this is what has been set or dictated by the market, and therefore consumers or producers sell at that market. Another example of this competitive market structure, still relating to mobile or telephone or telecommunication industry. I don't know if some of you came to meet it, but we used to have what we call the space to space, where you have people sitting under trees where you can go and make calls, right? You pay, they have the price that they charge for a minute if you make a call, right? So that type of market was also a typical example of a perfectly competitive market. It was very easy to enter the market. All you need was a table and an umbrella, and just sit under a tree and you can start engaging in that business and all that. And they were price takers, so they were fixed price for a minute of call and all that. Now that is the market that we are going to go into detail, right? But let's look at the other market structures. So we also have the monopolistic competitive market structure. Now this is a market structure, or let me look at the extreme, the monopoly market structure, before I come to the monopolistic competition. So the monopoly, I'm sure some of you might have even used the word monopoly before. You monopolize something, you know what it means. So in a monopoly market, there's just a single firm, right? A single firm in the industry who sells the product. In terms of the nature of the product, there are no close substitutes. It's just a single product and it's only sold by just one firm. Entry is blocked, so it's not easy for other firms to enter that industry. And then also the information asymmetry. So there's asymmetric information, there's imperfect information because it's just one firm that has all the information that there is to have. And then in terms of the firm's control over the price, the firm has control. When the monopolist is the one that determines the price. It has control. It can change the price at any time if it wants. Okay. So an example of this kind of market structures in Ghana, well, we used to mention the electricity company of Ghana, like ECG, used to be a monopoly, right? I don't know. Yeah, so they are the only firm that sells power. Although I'm told VRA sells power to some other, maybe some households in the northern part of the country, but largely the ECG is the only company that sells electricity to households in Ghana. So therefore, it's a monopoly in that industry, right? So it is the product is only one. There are no close substitute to it, power, and then it's not easy to enter. Entry is blocked. It's not easy to enter this industry or market. Information is asymmetric. Of course, they have power. Although Ghana, there are some laws that regulate them in terms of price changes. So there is the PURC, Public Utility Commissions, that approve price changes by the ECG and all that. And it's not only ECG, but even the Ghana Water Company as well. So we will look at this market extensively later on in detail later on. Now I can talk about monopolistic. So monopolistic is a market that has some characteristics of perfect competition and then some characteristics of a monopoly. And that is the type of market structure we see a lot in most of our markets, right? So in terms of the number of firms, there's quite a large number of firms, but not as large as in the case of perfect competition. So there's a large number of firms in that industry, but not as large as in the case of perfect competition. The product is not homogeneous. The products are differentiated. So you can clearly distinguish between the product of firm A from the product of firm B using a number of characteristics or a number of things to distinguish their products. Some do it through branding, some use packaging, some have logos and all that. So you can clearly say that this is the product for this firm and that is the product for the other firm. So you clearly see differences in the product, although they might be substitute. If you don't get this product for this firm, you can use the other product for the other firm, but they are clearly differentiated. And then in terms of barrier to entry, it is not free as it is in the case of perfect competition, although we can say it's also free and there's free entry and exit, but not as free as in the case of perfectly competitive market. So if a competitor or someone, an investor wants to enter the industry, the person can enter it easily, but not as easy as in the case of perfect competition. There might be some maybe registration to be done and all that, but there are no much, I mean, there isn't much impediments on the way of the firm if he wants to enter. And again, if you want to leave too, there isn't much problem. You can leave easily without much problem. In terms of information availability, yes, it's relatively good, but not as complete as the case of perfect competition. And then, yes, in terms of control, they have control over the price of the items that they sell because the products are differentiated, right? So they have control over the items that they sell. A typical example of this market structure in Ghana is that you can look at the restaurant industry or the fast food industry in Ghana. So there are so many of them. You know, even if you think of there's KFC, there's McDonald's, I'm told there is so many of them. If you go to Osu, you find so many of these fast food firms, and you can clearly distinguish KFC's product from McDonald's product, right? You can distinguish maybe a food from a Turkish restaurant from that from KFC. The way they even package it gives you the differences, right? And they have logos. KFC has its logo. You can immediately you see the packaging. You can clearly tell that this product is from KFC. Even if you don't see the package and you taste it, the taste can also even tell you that this is from KFC, right? They have differences in taste and all that. So that's a typical example of a perfectly monopolistic competitive market structure in Ghana. There are so many of them. Like I said, most of the markets that we see here are more of monopolistic competitive, where there are differences in the product, although they are mostly substitutes, but there are differences in the product. Another example, let's even pick the rice industry, the foreign rice or the perfume rice. There are so many of them. There's Millicent, there is what do you call it? Um, I've forgotten most of them. So there's Millicent Rice, there's Lily Rice, there is Royal Face, Royal Aroma, in fact, Royal something, Royal something. All those things are so you can clearly distinguish the product of one firm from the other. Go to the oil industry, there's Frito, there's Gino, there's that. So many of them, right? So that is the kind of go to the water, pure water market, for instance, although not the retail, but those who buy them in bulk. So you have differences. You have Voltage, you have Vena, you have Belacqua, and all that. All these are examples of monopolistic competitive. Okay, so somebody says there's Cindy Rice. This person, Abigail, I think you like Cindy Rice a lot. There's even Gucci. Hey, I didn't know there's Gucci Rice. I see. Um, so there are so many of this kind of market structure. Like I said, that is what you see a lot in our market. It is a monopolistic competitive market structure. All right. Hey, Google Rice. Oh, okay. So I don't know about Google Rice. All right. So now the last one is the oligopoly market structure. Now this is also you do see it in most of our markets as well. Now, it's a market that is characterized by few large firms. They are few but very large, right? and their products are either differentiated or undifferentiated. And in terms of barriers to entry, it's not easy to enter that industry like that. It's not easy to enter the industry. And then also information is not perfect, as in the case of perfect competition and the monopolistic competition. And of course, they do have control over the price of the items that they sell. Um, Maybe some time past, someone would have said that the banking industry was an oligopoly market where we had very few banks, very few large banks like the Barclays, like the Stanchart, and very, very few banks. But now we have quite a number of them. The market has been liberalized, so we have a lot of banks, local ones, and all that. So one would say maybe I can place banking sector under monopolistic competition, but in time back it used to be oligopoly, so we have very few of them. Another industry that satisfies this characteristics is the telecom industry. So we have MTN, we have Vodafone, we have Airtel, Tigo, and then what again? I don't remember. I only use MTN, Vodafone. The rest, I don't know. I'm told Glow is still there, and I don't know if it's still. So you have very few of them. Now they are interdependent in the sense that the actions of one firm sparks actions from the other firms as well. So if MTN comes up with a promotion or something, you are likely to see Vodafone coming up with the same, right? You're likely to see some reactions from Vodafone, some reactions from Airtel, Tigo, and all that. So Vodafone is running a promotion now that says that mobile money, Vodafone Cash to all networks is free, and all that. You see that if MTN realize that they are taking much of their customers, MTN is going to respond for that. You know, it can also come up with the similar thing to say that okay, it's also free and all that. So that is the kind of market that oligopoly market is. So the firms are interdependent and the actions affect each other. So if one firm takes action, you're likely to see the other firm also responding to the action taken by the other firms. So these are the four type of market structures, right? So what we are going to do now is that we are going to pick perfect competition and go into details. So we'll be looking at what are the characteristics of a firm in this industry and how does a firm in this industry maximize profit, both in the short run and in the long run. Now, we will be making use of the cost curves that we studied earlier. So please do not forget them because this is the point that we are going to use them. So I have explained what the perfect competitive market structure is, so I don't need to do that again. So again, a firm in this industry is a price taker. A firm in this industry is a price taker. And what we mean by price taker is that the firm has no control over the price of the item. The firm enters the market and starts selling at the price that the market has dictated. So it means that for this firm, his total revenue, which I'll come to, is not determined by price, but it determines by the quantities that it sells. So the price is fixed. So if it sells more quantity, it gets more revenue. If it sells less quantity, it gets less revenue. Right. So that is what we mean by a firm being a price taker. So it has no control over the price. Now let me stress this. That is at the individual level. So if you at the individual level, so individually, if you pick one firm, that firm has no control over price. But collectively, where we put all firms together and they all decide to change price, then yes, they can change price. So we will do a market analysis, and then we do individual firm analysis as well. Okay. So now let's look at how this firm, who is a price taker, maximizes its profit. So note that the objective of going into a business, as we have already spoken about, the main one is to maximize your profit. So if you do that, then we say you are being rational, right? So how does a firm in a perfectly competitive market maximize its profit? Now, the conclusion, in fact, the answer to this at the end of the day will be the thinking at the margin principles that we already know, which is the marginal benefit being equal to marginal cost. But before we get there, there are some few things that I want us to go through before we get to that condition of thinking at the margin or taking a decision at the margin. So first of all, let's look at the revenue for a firm that is in a perfectly competitive market, right? So we know that for this firm and all other firms, your profit is the difference between your revenue and your total cost, right? Your profit is the difference between the revenue and your total cost, right? Now you are told that this firm is a price taker. So in other words, for the firm, the price remains the same. The firm cannot change price to either sell more or sell less. So this firm is a price taker in this industry. So if you're a price taker, it means that your total revenue does not depend on your price. Your total revenue will be dependent on your output. Okay, so let me explain this further using the whiteboard to show you. So I'm switching to the whiteboard. So we know that for the firm, your total revenue will be equal to the price that you sell the item times the quantity of the items that you sell. So you are told that this price here is the same. It does not change. So it means that variations in total revenue will come from variations in quantity. So when you sell more, your total revenue will go up. When you sell less, your total revenue will come down. So that is what this point is saying. So for a perfectly competitive firm, the price is fixed. And therefore, the firm's total revenue is dependent on the quantity of output that it sells. Okay? Okay. So let's continue from there. It's dependent on the quantity of output that it sells, but not the price. Okay. So, given that, let's look at the revenue function for this firm then. So, what is the revenue function? It's just a function that shows the relationship between quantity sold and then the total revenue of the firm. So, as I've already indicated to you earlier, the total revenue of the firm is price times the quantity of output that the firm sold. So, the equation you see here is your total revenue function. Now, in addition to total revenue, we can generate our average revenue and also the marginal revenue for the firm, right? So now let me change this and switch to the whiteboard to explain this further. So I'm saying that the total revenue for a firm is the price times the quantity of the item that it sells. Then we can also distinguish between the average revenue of this firm and then the marginal revenue for the firm. Now note that this price here is a fixed price. So we can show that the average revenue of the firm is equal to the total revenue divided by the quantity. I believe by now we know how to find the averages. And that will be equal to the fixed price times the quantity divided by quantity. So the kills can cancel out. and this will be equal to the price. So this is one thing I want you to know. So the firm's average revenue is always equal to the price of the item, right? Be it whether if the price is fixed or not. But you at this point, we say that it is a fixed price. So for a competitive firm, average revenue is also equal to price. That is one thing I want you to know. So average revenue is also equal to price for a competitive firm. Marginal revenue, we know it is the change in total revenue divided by the change in quantity. And since we know that change in total revenue only results from change in quantity, then we can say that the change in total revenue will be equal to price, again, price of the item times the change in quantity over change in quantity. That will give you the marginal revenue. Again, this one will cancel out, and then we will be left with price again. So we are saying that for a competitive firm, that is a firm in a perfectly competitive market, marginal revenue is equal to price. Right? So from this point, what we are saying is that for a competitive firm, the average revenue of that firm or price is equal to average revenue, and at the same time is equal to the marginal revenue for this firm. So therefore, if I want to draw the curve for the price, the average revenue, and the marginal revenue for a perfectly competitive firm, then I'm going to have a horizontal line. So where I have quantity here, then I have price here, I have average revenue here, and then I have marginal revenue here. So this will be a straight line, which will indicate that price is equal to average revenue and at the same time marginal revenue. Now this is the demand curve for a perfectly competitive firm. So this is the demand curve. So that is the demand curve for a perfectly competitive firm. So the conclusion here is that for a perfectly competitive firm, the demand curve is horizontal. Please take note of that. For a perfectly competitive firm, the demand curve is horizontal. Right? It is horizontal because price is fixed. Price does not vary with the level of output. Price remains the same irrespective of the level of output. So therefore, the demand curve for a perfectly competitive firm, I'm not saying market, a perfectly competitive firm is horizontal, indicating that for this firm, price is equal to average revenue and at the same time equal to marginal revenue. And that's what we have shown mathematically. So please take note of this. This is a very important point for the understanding of the analysis going forward. If you do not understand it, just prompt me and then I can explain it now, because going forward, if you don't get this, you would be in trouble, right? So again, the demand curve for a perfectly competitive firm is horizontal, indicating that price is equal to average revenue and at the same time equal to marginal revenue. So please take note of this. This is a very important point that I want you to take note of, right? So I have shown, somebody's asking me to go over it. So please pay attention. I'm going to take my time to go over it for the next 2 minutes. Pay attention to it. So this is what I'm saying. So your total revenue for the firm is equal to your price times your quantity. Now your price is fixed because you are in a perfectly competitive market. So it means that total revenue changes with changes in quantity, right? So the thing that can change total revenue is the changes in the quantity for the firm or the quantity sold. Now let's look at some other revenue categories. We have the average revenue, right? So average revenue is just revenue per unit of output sold. And how do you get your average revenue? It's your total revenue divided by the quantity of output that you sell. Now we know that total revenue is the price times quantity. So I can express that here. Price times quantity divided by the quantity will give me my average revenue. Now mathematically I can cancel this. So I am left with what? Price. So therefore we can say that average revenue is equal to price in this case. And then we also have the marginal revenue. Marginal revenue, I believe by now we know what the marginals is. So marginal revenue is your change in your total revenue divided by the change in your quantity. And that will be equal to, now since revenue only changes with changes in output, then we can say that change in total revenue is equal to price times the change in output. That will give you the change in total revenue. And that will also be over change in quantity. So you can cross this as well. And again, you are left with what? Price. So again, marginal revenue is equal to price. So I'm saying that for a competitive firm, we have shown that price will be equal to average revenue for the firm and at the same time equal to marginal revenue. Now, this is what I was saying, that you can draw a graph of this. So if you have this graph where you have quantity on the horizontal axis, and then you have price, you have average revenue, and then you have marginal revenue as well, then you would have a straight line. And that line will have P being equal to average revenue and at the same time equal to the marginal revenue. Now this curve is what is known as a demand curve for a competitive firm. So it is the demand curve for a PC firm, right? And it's horizontal. And I'm saying that this is a very important point that I want you to note because it will play a significant role going forward. Note that for a perfectly competitive firm, the demand curve is horizontal. It is not downward sloping, as we know in our previous discussions of demand. For a perfectly competitive firm, the demand curve for its product is horizontal, showing that a firm can sell any quantity at that price that has been detected by the industry. So please take note of this. So this is a very important point. Now let's go back to the slides. Yeah, so this is the relationship that I have proven. So we see that the average revenue will be equal to the price, and then we can also show that marginal revenue will also be equal to price, which has also been proven here, right? So so this is a table that kind of explain the same things that I've mentioned. So you have the first column, which is the quantities, and then the second column is the price. Note that the price is the same, it's fixed, it does not change, right? So somebody is asking, the demand curve is so okay. So Kingsley is asking why the demand curve is it. So what is the demand curve? Demand curve shows the relationship between price and quantity, right? So in drawing the curve that I just showed you, one of the things on the vertical axis is price, isn't it? So this is price and this is quantity. That is why we are calling it a demand curve. A demand curve shows the relationship between price and quantity, right? So it's a demand curve because it is a relationship between price and then quantity, the quantity for the firm, right? So I hope that makes sense. Okay. So now let's go back to the discussions. So so this table is being used to explain the same concept that I have described earlier. So we have quantities there, we have price on the second column, which is the same, indicating that the price is fixed and therefore these firms are price takers. Total revenue will be price times quantity. So that is the first column times the second column. And then you can find the average revenue, you divide, and then the marginal revenue too. So that is what you have that as here. So this is it. So what do you see? You see that for this firm, price is the same as the average revenue and the same as the marginal revenue. So you see here, the second column is the same as the fourth column and also the fifth column, indicating that price is equal to average revenue and at the same time equal to marginal revenue. Good. So now, how does this firm maximize profit? So to maximize profit, the firm needs to combine the costs and then the revenue. Note that profit is the difference between your revenue and your cost. So we have looked at an aspect of the revenue. Now we want to look at an aspect of the cost. Now, this is a short run analysis. So let me make it clear. I don't know if I made it clear in earlier on that this is a short run analysis. So the firm is in the short run, not in the long run. So in the short run, there are three things that could happen in terms of profit maximization for the firm. The firm can make abnormal profit, which is the first one. It can break even, which is the second one. It can be making losses, right, which is the third one. Now, the shutdown can also be part of the third one, but we decided to separate it. So the shutdown can also be making losses as well. Or in fact, for the firm to reach the shutdown point, it means it is making losses. So the firm can be experiencing any of these three in the short run. It can make abnormal profit, which is the first one, making profit. Make normal profit, which is break evens in the second one. And then the third one, make losses, which includes the shutdown point. Now, I will explain these things, each of these with a graph to show you what the normal profit is, what is a abnormal profit, what are the losses, and at what point does this firm shut down, right? We'll do all that with a diagram. But before that, let's look at the marginal analysis, the what do you call it? The taking decision at the margin, right? Taking decision at the margin first before I can show you all these categories of profits that a firm can make. So from our discussions under consumer behavior, our discussions under um, um, marginal, what do you call it? Under discussions about productions and all that, we know that for every activity in economics, I mean, to find out the optimum level of that activity, the rule is that engage the activity up to the point where the marginal benefit of the activity is equal to the marginal cost. So the same principle is applied to the firm in this case. So the decision the firm is taking here is what quantity should it supply to maximize its profit. That's the decision of the firm. What quantity of output should a firm supply to maximize its profit? Note that the firm has no control over price. So what the firm can do is to either sell more quantity or sell less quantity. So the decision is on the quantities that needs to be sold in order to maximize profit. And the rule is that the firm should sell quantity up to the point where the marginal benefit is equal to the marginal cost. So what is the marginal benefit here? The marginal benefit here is the marginal revenue. And of course, the marginal cost is the marginal cost that we know from our discussions of cost earlier. So the rule for profit maximization for a firm in a perfectly competitive market is that the firm should sell quantity that will equate marginal benefits, which is in this case the marginal revenue, to the marginal cost. And that quantity is a profit maximizing quantity, right? So if the marginal revenue for the firm is greater than marginal cost, the firm should sell more. And if it is the reverse, then the firm should sell less. But if it is equal, then the firm ends at that point. So the quantity that will ensure that marginal revenue is equal to marginal cost should be the quantity that this firm should sell. And it is at that point that we'll decide whether the firm is making abnormal profit, making a normal profit, or making a loss, or should even shut down, depending on the average total cost and then also the average variable cost for the firm. So I am going to draw the profit maximizing condition graphically for you. But before I do that, this is an example of the profit maximizing condition. So we have the quantities of bottles. We are transferring the exercise that we did earlier. So you have your total revenue. And in this case, you have your total cost. And then, of course, the profit is your total revenue minus your total cost. And then we also have our marginal revenue as well, and then marginal cost. So where marginal revenue is equal to marginal cost should be the quantity that this firm should sell in order to maximize the profit. So if you look at the data, you see that at the quantity of 5, marginal revenue is equal to marginal cost. So therefore, this is the profit maximizing condition or profit maximizing quantity for this competitive firm. Now I'm going to show this condition graphically, right? I'm going to show it graphically. So to do that, let's just switch to our whiteboard. So I have my whiteboard here. So let's draw it. So we know that the firm's marginal revenue curve, the firm's marginal revenue curve is the same as the price line. So this is the marginal revenue curve. So it is P equal to MR and at the same time equal to AR. So you have price here, you have MR here, and then you have your AR there. Now let's draw our cost curve. So from our earlier discussions of cost, we know that the marginal cost curve is U-shaped. So you can draw your marginal cost curve as that. So this is your MC, right? So we are saying that equilibrium is where the MR is equal to MC. And that happens here. So if you trace this down, this will give you the quantity that will maximize the firm's profit, right? Now, because for a perfectly competitive firm, MR is equal to price, right? MR is equal to price. The equilibrium condition is restated as price is equal to MC for a perfectly competitive firm. because MR, marginal revenue, is equal to price for a perfectly competitive firm, the equilibrium condition is restated as price is equal to the MC, and that only occurs here. Now, one would argue that if I draw the MC curve properly, a U shape, then it's going to cut the price line at two areas. So I can include this, right? Now, the equilibrium will not happen here because at this point, MC is falling, and therefore it is advisable to continue to produce. Only stop when the MC has started rising. So therefore, the equilibrium condition will occur here, but not here. Right? So that is why in most cases, when you look at the textbooks, when they draw the MC, they don't include the falling part. They only focus on the rising part because the equilibrium will not happen at the falling part. It happens at the rising part. Okay, so this is the equilibrium condition. So let me just draw it again. So this is the equilibrium condition. So again, we have our demand curve, which is measuring price. So price is equal to average revenue and at the same time equal to marginal revenue. And then you have your marginal cost line, the short-run marginal cost, and then where they cut each other is your equilibrium condition. So here will be price. Okay, so we have price here, and I have my average revenue here, and then I have my marginal revenue here as well. So this is my equilibrium condition. So please note this equilibrium condition. So for a perfectly competitive firm, the firm is in equilibrium when price is equal to marginal cost. In fact, the equilibrium condition itself is when marginal revenue is equal to marginal cost. But because price is equal to marginal revenue, this equilibrium condition for a perfectly competitive firm is restated as price is equal to marginal cost. Okay, now let's move on. Let's go back to the lecture slides. Okay, so now given that we know what the equilibrium condition is for a perfectly competitive firm, it's important that we look at what point does this firm, although we are saying that it is when MC is equal to P, but there are some point that this firm might not produce, right? So we want to look at the shutdown decision of this firm. Now, a shutdown can be temporal or a permanent one, right? So there are certain conditions that if they prevail, this firm will shut down temporarily or it will shut down permanently, right? So now let's look at the shutdown conditions for a firm in a perfectly competitive firm. But this will be a temporal shutdown, right? Okay. Now, and I want to explain this using the whiteboard, right? A lot of things are said in the slides, so many bullet points relating to that. But I'm just going to use one diagram to just summarize all that. And therefore, you don't have to worry yourself so much with the what do you call it? The slides. It's a lot, but explaining the same thing that I'm going to use the diagram to explain. So again, let me just switch to the shutdown point using the white board. Okay, so this is it. So now let me put all the graphs together. So I have my quantity here, I have my price here, I have my average revenue here, and I also have my marginal revenue here. And then this is the demand curve for the firm, which is price is equal to marginal revenue and at the same time equal to average revenue, right? And then now I'm going to add two more cost curves. So I'm going to add my average total cost curve. And then I also have my average variable curve. And then I have my marginal cost curve. Okay. Now let's look at the shutdown point. So price, there is a difference between price and then the average variable cost, or let's say average total cost, determines whether this firm is making profit or not. So if price is greater than the average total cost, then this firm will be making profit. I will show that again with a diagram. And if price is greater than, if price is less than, so if price is less than ATC, then this firm is making a loss. But if price is greater than ATC, then this firm is making a profit. Okay, now let's focus on the loss because that is what explains the shutdown point. Now the question is, if a firm is experiencing this, so the price that the market has been detected is lower than the average total cost for this firm, it means the firm is making a loss. Now the question is, should this firm exit the market? Should this firm exit the market? And the answer is not necessarily. It depends. So you go further. If this firm is making a loss, but at least it is covering its fixed cost, right? So you are making a loss, all right. But the price is such that you are able to get your average fixed cost from the price. Then people believe that you can continue to stay in business and hope that things will get better. Once things get better, maybe prices will change or you will come up with technologies that will minimize your average total cost so that you can still be making profit. Right. So the fact that the firm is making a loss does not mean that it should exit the market immediately. What the firm has to look at is whether the price is greater than the average variable cost. Right? Whether price is greater than average variable cost or price is less than the average variable cost. If price is greater than the average variable cost, then it means that, oh, it can still stay in business. It means that it is covering its fixed cost, right? It is covering its fixed cost and then covering its average variable cost, right? It is covering its fixed cost and covering average variable cost. So the firm should stay in business. However, if price is less than your average variable cost, then you have to shut down, because what it means is that your variable cost, the cost that varies with your level of output, you are not getting that. Your price, or the price that the market has been detected for you, you are not getting that. So if you are not getting that, then why are you in business? For the fixed cost, whether you produce or you don't produce, you incur it. It's a fixed cost. So if I'm going to produce, then at least I need to get the cost. I need to recover the cost that varies with the level of output. If I don't recover that cost, then what's the point? Then I should shut down. So that gives us the shutdown point. So if price is equal to your average variable cost, then you have gotten to a shutdown point. Anytime price falls below it, then you have to leave the market. You have to shut down, because at that point, you are not covering your average variable cost. So this is what I'm saying in terms of graphics or the equation. So a firm makes profit when the price is greater than your average total cost. You make loss when price is lower than average total cost. But do you leave the market? And the answer is no, it depends. If price is greater than your average variable cost, then although you are making a loss, continue to stay in business because things can get better. You can have or come up with technology that will let you produce at a lower cost so that the existing price can give you profit. But if price is less than your average variable cost, then there's no point in being in the business. You have to leave the market. You have to leave the market. Shut down temporarily and then hoping that things will get better. When things get better, you can come back. Note that for your fixed cost, you cannot dodge it. Whether you produce or you don't produce, you are going to incur the fixed cost. But what you cannot afford to be losing is your variable cost, which varies with your level of output. You have to recover that. If you don't recover your variable cost, then there's no point in staying in business. So that gives us a shutdown point, which I'm going to explain with this diagram. So we have quantity here, and then we have the price, the average variable cost is also here. Now this will be a lot. Now there are a lot of things there. So you have, oh sorry, I want to draw it big. So you have price here, you have average variable cost here, you have average total cost. They are all on the same line. And then you also have marginal cost there. So I'm drawing the curves. So this is my, oh sorry. So this is my ATC. This is my AVC. Note that the AVC lies below the ATC. And then this is my average, or sorry, marginal cost, right? So if price is above this, let's say this is price. This is price. So it means that this firm is going to produce this quantity. This firm is going to produce this quantity. But at that quantity, you clearly see that the average total cost is above the price. So this firm is making a loss. But should this firm exit? Now you clearly see that although the average total cost is above price, this firm should stay in business. It should not exit because the price that it is selling is above the average variable cost. So it should stay in business. But if price falls below, so assuming price is this, P2, then this firm at the same quantity should leave the market immediately because the price that the market has dictated for the industry is lower than even the minimum of the average variable cost. So this firm should exit the market. So this gives us a shutdown point, which is the minimum. So the shutdown point, shutdown point is when price is equal to the minimum of the AVC shutdown point. Let me clear this and draw it again. So I have the diagram here. Now I want to draw the shutdown point. So this is my average total cost, and this is my average variable cost. Note that the marginal cost passes through the minimum of the average variable cost and then also the average total cost. So if price is equal to this here, the minimum here, then this is the shutdown point. Anytime price falls below this point, the firm should leave the industry. The firm should shut down temporarily and wait, hoping that things will get better and then it will come back. So this is the shutdown point. So the shutdown point is when P shutdown point is when price is equal to the minimum of average variable cost, right? So that's the shutdown point. When price is equal to the minimum of the average variable cost, then the firm is at the shutdown point. Okay. Now we can use this shutdown point to draw or obtain the supply curve for the firm. We can use this shutdown point to obtain the supply curve of the firm. But before I do that, let me go back to the slides and then see if I have covered everything under the shutdown point. And then I'll come back to using that to draw the supply curve of the firm. So this is the whole point about the shutdown point that I have discussed with you. So the same thing. So therefore, shutdown if P is less than that. I've explained that. So if you get the slides and then you look at it, so the shutdown point is what I have given you here to indicate that is the point or is the output and price at which price equals to the minimum of the average variable cost. So this is what is used to explain that, right? We use this to explain the shutdown point. So these are the graphs that I was drawing in earlier using the whiteboard. So you have the MC line, and then you have the AVC line. You also have the ATC line. So this is the minimum of the ATC line. So here you clearly see that this is where the MC is equal to MR or is equal to price. So this will be the equilibrium point, but it happens to be at the minimum of the average variable cost. So this firm should shut down, right? So at that, so we can show that at the shutdown point, losses are equal to the total fixed cost. Because that point, like I said, the total fixed cost, you cannot do anything about it. Whether you produce or you don't produce, you are going to incur it. So if that will be your only loss, that's fine. Compared to you producing, but you are not even recovering the variable cost. In that sense, it will not be the best. Okay, so all these things are explaining the shutdown point. These are all explaining the shutdown point. Okay, so now I want to quickly. What time do I have? I have some few time. Okay, so now let's look at the short run supply curve of the firm. Now, when we are done, then I'll come back to explain or using diagram to explain where the firm is making abnormal profit, the firm is making normal profit, is making a loss and all that, right? So let's go back to the whiteboard, and I want to use that to explain the supply curve or the short run supply curve for the firm, for a perfectly competitive firm. Okay, so now let me draw the shutdown point diagram again. This diagram is crooked. This line is so straight line, and then I have it this way. Okay, so I have my price here. There is also the ATC here. There is also the AVC, and then I have my MC. So let me draw my ATC curve, and then let me also draw my AVC curve, and then I have my MC curve. Okay, so note that we said this is the minimum. So from what we have just indicated, we are saying that anytime price falls below here, the firm should not supply. In other words, to shut down. So anytime price is below this level, this point here, anytime price is below P1, the firm will not supply. But if price is P1, then the firm is going to supply this quantity of output. When price is above, assuming price was above P1, then it will supply this quantity of output because that's the equilibrium condition. Again, if it is above, it's going to supply this quantity. And if it's above again, oh, my lines are terrible, it's going to supply this quantity. Now, what do we see? We see that the supply curve for this firm will start from here. It is going to be 0 from here up to any price within this range. The supply curve is 0, or the firm does not supply anything. Then it gets here. Then once it gets here, there's a break, and then it starts from here. So from here it goes up. Any price above the shutdown point, the firm is going to supply this quantity. So what we'll say is that the firm's supply curve, that's for a perfectly competitive firm, the firm's supply curve is that portion of its marginal cost that is above the AVC. So is the portion of the MC which is above, or that is above the AVC, right? So starting from here, so here it's all 0, and when it gets here there's a break, it goes here. So here you can see, okay, a straight line, but you don't supply this quantity in between, it supplies here. So there's that break here, and then from there, any price above it, it is going to supply higher quantities, right? So you see that the supply curve will be just the part of the MC that is above the AC. That is the supply curve for the firm in a perfectly competitive market. So I can draw it again to indicate the supply curve by just using the, so this is the, let me say this is the AVC. I'm using only the AVC. And this is the MC. So the shutdown point is here, the minimum. So this is the price. So any price below P, the quantity supply is 0. But once it's at P, there's a jump there, and that will be what will be supply is Q1. And then any price above P1, the firm will supply positive output. So here is going to supply this, is going to supply this. So you see that the supply curve for the firm will be here. There's a break, and then it goes here. So this will be the supply curve of the firm. So that part of the MC that lies above the average variable cost, that will be the supply curve for the firm. So let's quickly go back to the slides, and then you see that it's basically what I've just explained to you. So a perfectly competitive firm's short-run supply curve shows how the firm's profit maximizing output changes as price varies, other things remaining constant. So it is here. So this is it. So this is what that is trying to draw for you. So in the end, you see that if you go through the slides, that's what has happened. So you see that it is just this portion here, and then there's that break, and then supply curve starts. So this here, this blue line that you see here is this portion of the marginal cost curve for the perfectly competitive firm, right? So the blue line here is the supply curve for a perfectly competitive firm. So that is what this is trying to explain, right? Okay. What is the time? I see that some are being logged off. I don't know if that is a problem that we have, and maybe they are trying to log on, they can log on again. But I think I probably would want to even end today's class here. So the next time we meet, I am going to, which is group 2 is Tuesday, right? So I will continue from the market supply. Or let me just quickly add the market supply, then I can. So, I mean, we know that from our demand and supply analysis, we know that the market supply is the horizontal summation of the individual market supply. So it's the same thing here. So this is the firm. So to obtain the market supply in the short run, it is still the horizontal summation of the individual um, firm's supply, right? So it is just the same thing here. That's what you see. So this is, we are assuming that if there are 1,000 identical firms in that industry, then the market supply at each price will be the quantities of each of the firms, the sum of the quantities of each of the 10,000 firms. And that's what you have here. So it's the same thing. So you see that the market supply curve will have the same shape, I mean, as the individual firm supply curve. So you have it that way, right? So it's the same thing. These are the same principles that we have. Okay. So the market supply curve, below the shutdown point, it runs along the y-axis, just as the individual supply curve does. So at the shutdown point, it's perfectly inelastic. So this is what we are saying here. It's perfectly inelastic here. And then above the shutdown point, it slopes upward. Okay. So I think that should be fine at this point. Somebody wants me to come again on the supply curve. So this is what we are saying. So we are saying that what is a relation? So for the firm, what is the relationship between price and quantity, right? And then I have explained that there's a shutdown point, which I believe you do understand. So any price that is below the shutdown point, the firm will not supply quantity. So let's say this is my average total cost from our discussions earlier under cost. This is my, sorry, let me clean this and draw it again. So this is my average total cost. This is my average variable cost. And this is my average variable cost. And then my marginal cost will pass through the minimum of these. Now, from our earlier discussion, we are saying that this is the shutdown point where price is equal to the minimum of the average variable cost. So it means that if price is exactly equal to this point, then this firm would, the quantity that will maximize its profit is Q1. But any price that is below P1, the firm has to shut down. And if you are shutting down, it means you are not producing. So it means that you are going to supply zero quantity of output. But any price that is above the shutdown point, you are going to supply. So assuming that the price is P2, if the price is P2, this firm would have to supply where price is equal to MC. And that happens here. So this will be the quantity this firm will supply. Again, if price is P3, then it's also going to supply the quantity that we equate price to MC, and that also happens here. So you can trace it down. So you can trace different combination of price and quantity, which you can put in a price and quantity quadrant, and that gives you the supply curve for this firm. So we are saying that for a perfectly competitive firm, if the price is below the shutdown point, it will not supply any quantity. The quantity that it will supply will be zero, right? But once price is equal to the shutdown point, then it supplies this quantity. So there's that break. But any price that is above the shutdown point, it is going to supply positive quantity. So that's why we are saying that the firm supply curve will be this region. There's a break, and then it goes up. So normally we don't bother ourselves with this part of it. We focus on the part of the MC that is above the average variable cost. And that's what we mean by the supply curve of the firm. So we are saying that for the industry or the market, you do a horizontal summation of these individual supply curve, and that will give you the industry supply curve or the market supply curve. And it will have the same shape as the individual supply curve. Right? I hope this is better now. Okay, so the next time we meet, I think on Tuesday, I am going to now look at what point is a firm making abnormal profit? When is it making normal profit? And all that, right? So that we can, yeah, so we'll proceed from there. And then when we finish, we do a long run analysis. And then we can move on into the other market structures, right? So I need to complete everything next week. So maybe at some point I will have to maximize my speed a little bit. So somebody has asked a question. Let me see. Can we say that shutdown point is the same as equilibrium point? No. So a shutdown point can be an equilibrium point, right? A shutdown point can be an equilibrium point because it can be a point where if price is equal to the minimum of the average variable cost, then that shutdown point is also an equilibrium point. But it's not all shutdown points that are equilibrium points. You can have an equilibrium point that is above the shutdown point, right? So equilibrium point is where P is equal to MC. And if it happens at the minimum of the average variable cost, then it's a shutdown point. Okay, so I hope that makes sense to you now. Who asked the question? Benjamin. I hope that makes sense to you. Okay. So somebody's asking about the nature of the exams. I honestly, for now, I don't know. We are yet to set the exams questions. So when I get to know the nature of the exams, I'll let you know. But like we said, or like I said to you, it is face to face. You are coming to write it in exams. It's not online. It is face to face, and you are going to have written. So as to the number of questions and all that, we are yet to agree on that. So once we agree, I'll let you know, all things being equal. Any question on this? Okay, so if you don't have any question, then I think I can end the class. Once the recording becomes available, I would send it to the class rep, and the class rep can make it available to you. Have a good evening, and bye-bye.